So in July of next year, interest rates could turn negative for the US, and for the UK, it could happen even sooner. December 2020 is when it is predicted. So that means that banks will start loaning us money and paying us interest on top. Sounds a little too good to be true, and it probably is. In this video, we'll be talking about what negative interest rates are, why they could come about, and importantly, how they affect you and me. I'll be breaking this down into 6 key factors: your savings account, your car loan, your mortgage, the stock market, the economy, and real estate. These things are important. That's why we'll be looking at how other countries who've had negative interest rates in the past and have them today have been affected from these 6 different angles. Now, there's going to be a time code on the screen somewhere, so if you would like to skip ahead and simply watch how this could impact you, feel free to do so. But I think it's also important to really understand how this could come about in the first place. So let's get into it. The first question is why? Why is this likely to occur? After all, Jerome Powell, the chair of the Federal Reserve, USA's central bank, has repeatedly said that negative interest rates aren't going to happen. He doesn't think it's a good idea. So where is this coming from? Well, other than the likes of Donald Trump constantly calling for the US to move to negative interest rates, it really comes down to something called the futures market. It sounds more complex than it really is. Essentially, imagine you have a mate called Bob. Bob comes around your house and he says, "I'll buy your car off you." You say, "Cool, sounds good. I'd like $5,000 for it, please." And he agrees on that price. You end up writing a contract. That is simply buying something off someone. We're all familiar with that. Now imagine Bob comes round and says, "I'd like to buy your car off you." You say, "Of course, Bob, no problem." But this time he goes, "I'm actually not going to buy it now. I'm going to buy it in 6 months." You say, "That's a bit weird, Bob. I don't know why you want to buy it in 6 months, but okay, agreed. I'll sell it to you in 6 months." And then you write up a contract. That's all a futures contract is. It's an agreement to buy or sell something in the future. Now, this example with Bob is pretty odd, agreed. You aren't likely to do this with your car. But with interest rates, this is exactly what many people and large financial institutions do. They agree on a price in the future. So if they are agreeing a price in the future, they're also kind of making a prediction of what they think that price is going to be. After all, if Bob came to you and said he'll pay you $5,000, but he thinks that the car is going to be worth $4,000 in the future, why would he pay you $5,000? He'd agree on a contract that was worth $4,000 because that's what he thinks the price is going to be. So these futures contracts, these futures markets become like a gigantic prediction market for where the price of things is going to be in the future. And these prediction markets, these futures markets, have for the first time predicted that the UK interest rate is going to turn negative in December of this year, and for the US, it is going to be July 2021. So in other words, the people in charge are saying it's not going to happen, but the president wants it and the markets are predicting it. Ultimately, we have no guarantee, but it does look likely. Still though, you're probably wondering the key question: why would anyone in their right mind loan someone money and then pay them interest on top? It just doesn't make sense. Well, we have to understand how negative interest rates work. Before we get into that though, I'd like to say that this video took a long time to research and to record as well. In fact, I'm currently on my 24th minute of recording, takes over and over, and this is probably about 3 minutes into the video. So if you wouldn't mind liking, that would be greatly appreciated. So the first thing to understand is that it's unlikely a bank is ever going to pay us in order to loan to us, because that would be an interest rate between us and the banks. There are other interest rates in the world, and these are more likely to be affected. You see, there are 2 types of banks. The first one are the commercial banks. These are the ones you probably have a bank account with, and they're on the high streets. In the UK, that's the likes of Santander or Halifax. In the US, think Wells Fargo or Bank of America. And then the second type of bank is known as a central bank. A central bank isn't on the high street, and you will never interact with them. Their job is to raise and lower interest rates in order to affect the economy. So think of them as kind of like the government, except they are actually their own separate thing. Commercial banks often have a lot of excess cash and they need to deposit it somewhere safely. This is when they turn to the central bank and they deposit money. In the past, this interest rate has been positive. So, in other words, Santander or Wells Fargo will give money to their central bank and receive an interest rate in return. However, if interest rates turn negative, this is where things flip. So, those commercial banks may continue to deposit with the central bank, but now they're going to be charged money for doing so. So, why? What is the reason for doing this? The idea is to make banks reevaluate. Why leave their money somewhere which costs them? They might as well keep hold of it themselves. And even better, they might try to make some money with it. And that means loaning money to regular people and businesses. With more loans, this could kickstart the economy. In theory, it leads to cheap loans, and that results in more business and consumer spending. And of course, that is good for the economy, the stock market, and other assets such as real estate. It also weakens your national currency, which on the surface doesn't sound like such a good thing. But by weakening your currency compared to others, you're actually improving your exporting businesses, which again is generally good for the economy. And the other benefit is that you get to avoid deflation. So we're all familiar with inflation. That's when the prices of assets rise over time. Deflation is when they drop over time. Again, on the surface, it may actually sound like a good thing, but deflation is strongly associated with recessions and depressions. We obviously don't want that, and negative interest rates can help us avoid it. But what about some of the risks? What are some of the concerns with doing this? Well, the first one is high and even rampant inflation rates. With more loans, the value of assets tends to rise. Think about it like this. Imagine you want to buy a house. You've saved up $50,000 and your dream house costs $250,000. You go along to an auction and you wait for this house to come up that you want to bid on. If there is no ability to borrow any money, then the most that you can bid is just $50,000. Once it goes past that, you're out. In fact, with probably fewer people bidding all the way up to 250k, the value may come down. Let's say it drops to 200, 180, but still, you can't buy it with your 50,000. Now what happens if there's loads of loans in the economy and you're given a 90% loan? You go from the ability to bid just 50,000 all the way up to 500,000. So that house comes on auction and it gets to 250 and you're thinking, this is where I want to settle. But someone else also bids 260. So now you're bidding 270. Someone else bids 280 and you bid 290. Settled. Done. You've won. But that price has now gone above what it previously would have been. Instead of stopping at 250, because you were competing with someone else in the market because they could also borrow a lot of money, it caused the value of that asset to rise. That's the effect that loans have on asset prices. And when we're talking about houses here, it applies to just about everything. Real estate, stock markets, and even everyday goods. So negative interest rates, they can help us avoid deflation, but they can also lead to high inflation. There's also the concern of what happens if the economy gets worse. Generally, when the economy isn't doing well, we drop interest rates down. But when they're already negative, where do you go from there? There's also concerns about the long-term viability. Sweden, for example, ditched negative rates in 2019 as it was affecting banking and insurance. So there are questions as to how long it really can work for. Now let's talk about how this affects you and me. How is this likely to impact on those 6 key factors of our lives? Savings accounts, mortgages, car loans, the economy, the stock market, and real estate. Let's kick it off first with the savings account. So there's 2 questions to answer here. Is it going to cost us money to deposit with the banks? And are they going to give us money and also pay us interest on top? I think the first one is maybe slightly obvious. It's unlikely that banks are ever going to pay us money in order to loan to us. It's not impossible, but it seems pretty unlikely unless they become kind of charitable, which for a bank doesn't really match what they're going for. What about depositing with them? Is it ever going to cost us money? Well, if banks did this, it would make us unlikely to deposit with them. After all, why would we leave our money in a bank if they're going to charge us on top? As a result, we might start withdrawing our money, and that is bad for the banks. But to play devil's advocate here, there's actually 41 banks in Germany right now that are charging for deposits. Most of them only charge for very large deposits, but in fact, 7 of them charge even for small deposits. So while there are incentives for banks not to charge us for deposits, It is certainly not impossible or even unfeasible, with banks in Germany doing exactly that right now. The interest you're charged on a car loan tends to vary with credit score. But for the US, the average is 5.27%. And for the UK, I wasn't able to find an average, but looking at calculators, it looks like it's a very similar number. Now on the screen, you can see two charts. One is the average interest rate for car loans in the US, and the other one is the Federal Reserve interest rate. This is the value we've been saying could turn negative in the next year. There is a correlation between the two. As the federal rate rises, the car loan rate also tends to rise. As the federal rate drops, the car loan rate also drops. But as we can see from the car loan chart, it tends to still stay in a pretty narrow sector, above 4% and generally around about 5%. So if the federal rate drops below zero, it's likely the car loan rate is also going to drop. But as we can see, it's probably not going to drop that much. It's certainly never going to drop below zero. Unfortunately, I can't imagine any reality where a car manufacturer pays you to not pay them all of the money up front. Now, let's talk about mortgages. Mortgages tend to roughly track the federal rate. So when the federal rate goes down, mortgages tend to go in the same direction. And when it goes up, mortgages tend to increase. But at the end of the day, it is a bank loaning you money, and they can charge you whatever they want. So while they could drop those rates, they could also choose not to. I think it seems likely that we could see a drop in the rates, but don't expect it to drop as much as the federal rates. If you are holding out hope for a negative interest rate mortgage, I have some surprisingly good news for you. There is actually a Danish bank called Jyske Bank, that's probably totally wrong, but they have offered a minus 0.5% interest on a 10-year mortgage. That's right, they've actually loaned people money, and while of course those people are paying back the money, they're paying back less with each payment. Instead of the payments stacking up and the interest rate adding to the value, it's actually decreasing the value over time. Now, of course, this is also a 10-year mortgage, not a 15, 20, or 25-year mortgage, but it is pretty incredible to see that a negative interest rate mortgage is a thing that genuinely exists. When it comes to real estate prices, cheaper mortgages are of course a good thing. It means that people who couldn't necessarily get on the property ladder before can buy their first house, and investors can build up a larger portfolio because they need to make smaller repayments each month. They can buy more houses, and that tends to push up the price over time. So all of this going on, of course, is going to be good for the price of real estate. But there's a lot that's going on at the moment which is bad for the prices of real estate. So yes, dropping the interest rates to negative is likely to cheapen mortgages, and that's likely to be positive for real estate prices. But the key question is that going to overcome the negative forces? We have had a bull run for approximately 12 years, which is one of the longest bull runs ever. We've been overdue a recession, and we have this pandemic going on. So it isn't a simple yes or no. It is a simple yes, it's good in fact. But the question of are real estate prices going to increase? That is not a simple question. It is up to you to decide, make your own decisions to determine whether the positive factors which are going on, such as this, will be able to overcome the negative factors. The biggest impact for the economy is likely to be cheap loans. Cheap loans means more borrowing for businesses and regular people, and that leads generally to business growth. So lowering the interest rate could have a positive impact on the economy. But again, it's the same with real estate. There's lots of negative things going on in the world. So the question is it going to have more of a positive impact than the negative we're already seeing? With the stock market, the same forces apply. Cheap lending means more business growth, but we have those negative impacts going on in the world right now, so you have to assess, do you think the positive is going to outweigh the negative? For that, I tend to hold my hands up and say, I don't really know. I don't think many people do, but I tend to look at what the smartest people in the world are saying. They know a hell of a lot more than me, and therefore their actions and their assessments are more likely to be accurate and better, more value for you than me simply sitting here and saying what I think is going to happen. So, two of my idols when it comes to investing are Warren Buffett and Ray Dalio. Warren Buffett has recently been saying that one of the best things investors can do is buy an S&P 500 index fund. But at the same time, he has become a net seller in his company Berkshire Hathaway over the past 12 months. And he sold all of his airline shares. So if you listen to his words, they sound maybe somewhat bullish, but his actual actions are incredibly negative. I actually produced a whole video just on this topic, breaking down what his actions could mean for the stock market. So overall, Warren Buffett appears slightly pessimistic, certainly not optimistic based on his actions. Ray Dalio is even more pessimistic. He believes that we are headed into a depression the likes of which the US hasn't seen since the 1930s. This is really interesting, and there's a lot to unpick there, which I won't do in this video. But what I will say is on Friday, I'll be releasing a video on this exact topic, going into detail about why he believes these things and how, as investors, we can personally protect ourselves. So if you're keen to see that video, make sure that you're subscribed, or if you're watching this after Friday, and this should be released on Wednesday, then simply click on the channel link because maybe the video is already even out. At the end of the day, nobody knows what's going to happen. So be smart, be safe, and invest into one thing: smashing that like button. In all seriousness, I'm going to be releasing a lot of content breaking down what the smartest investors in the world think and how we can learn for our own personal investing. So if you want to see more videos like this, or maybe this one right here, then consider subscribing. Thank you.